All right, we are back. My name is Doug Sandler, along with John Browning. John, welcome back to the podcast, Building Your Life and Not Just Your Portfolio. Let's build a better life. I'm ready to do it.
All right, let's do it. Let's get to
So,
work.
so one of the topics that you had mentioned in our preliminary conversation and the email sequence that we send each other, well in advance of recording day, is is when do the economic conditions actually matter to me? And I think I'm going to let you provide the answer, but it's such a beautiful answer because it is so factual, so true. So if you're out there thinking, when do the economic conditions actually matter to me? John, what is the answer?
Arguably never.
I gotta giggle out of that because then I thought about it. I'm like, when I saw that answer, I'm like, you know, he makes sense. He actually makes sense. So why do they not matter to me?
So, those of you who listen to me often know that I have a daily update, and that's because people like it, and I have to do the research anyway because that's kind of my job, right?
Right.
So I pay attention to the economic indicators, and if you listen to me on the daily episode, a daily short 5 minute update, then you know that I give you the economic update, what's going on this day, this week, along with more of a long term perspective. But arguably, like it's really interesting to me that my clients think sometimes that it's really important. I had a client recently that emailed me, a counter argument to. He thought it was a counter argument. It's not really. Someone who thought that inflation was going down and wasn't a problem anymore. And my response was, well, I think it's going down too. As a matter of fact, all indications show that it is going down. I'm not
Mm-hmm.
disagreeing with you on that. So, and but then he said, well, it's actually disinflation. I said, well, I would tend to disagree with that, but it doesn't really matter. Well, how can it not matter? How can inflation not matter? Well, if you're invested properly for you
Mm-hmm.
in a way that is right for you, and if you have a financial professional that is doing their job well and is watching all of this stuff and making the adjustments or not making any adjustments,
Mm-hmm.
then you shouldn't worry about that.
I love that because it takes I'm not saying to bury your head in the sand and ignore what's going on if you're in our listening audience, but when you have an advisor that is a professional, which an advisor should be, somebody, a trusted, learned professional, but I rather put the worry on your shoulders, John. I don't want to carry the burden of worry. And you don't even worry about it. You just know because you're dealing with the market on a daily basis. You look at it. I can't tell you again, I'm not saying this from a good perspective. It's just how I am. I don't want to look at the market every day. I don't want to open up my statements every month because if I'm 15% down or if I'm 15% up, I'm still a decade away from retirement. What change am I going to make? But you look at it from a different, from a different vision, a different focal point.
Exactly. And it's my job and I love it, right? I enjoy it. It's just sort of a nice little, it's a fun puzzle that's always changing. Like you look at the puzzle piece 1 second and it's a different shape the next one, and you got to figure out where it fits, right? And I love that kind of stuff. But most people don't. So if you've got somebody doing that, there may be times in your portfolio where absolutely no change should happen or very little change should happen, and it can go on for a period of a year or even longer. Maybe no changes need to be made. It's possible. Pretty rare that would be that long that nothing would change, but you should still understand why. But you should call your financial professional and say, actually, you shouldn't call them, they should be calling you or
Right,
letting you
right,
know,
right, right.
hey, this is the reason we haven't made any changes. And it should sound like you should understand it. But in general, the reason that I make changes in portfolios are, yes, based on economic conditions, but I don't come in and out of the market. I don't time the market. I don't think you
Right.
can do that on a regular basis. We've talked about that before. Will I make adjustments based on asset allocations and what's done well or poorly and what is likely based on economic conditions to do well or poorly? Yeah, I'll make adjustments, but they're not going to be like 10 or 15 or 20% adjustments to a portfolio. They're going to be 2 or 3% or maybe up to 5% adjustments, that type of thing. So,
Well, I like one of the things that you had said, which was sometimes one of the best things to do is nothing at all. And here is why I'm doing nothing. When I have someone that is an advisor to me, not just financial, but anybody that's in my life as an advisor or an accountability partner for me, I like to know why I'm not doing anything, why that's the right decision. And I even like to be notified that nothing is what we're doing right now because that's the best decision. Because at least now I know there's some conscious effort that went into doing nothing. And that's okay.
right. And the problem is, and this is, we talked about this last episode too. There are bad actors out there, and there are also not necessarily bad actors, but actors that, um, I don't know whether it's they're lazy or just don't like doing like this part of their job. But I have seen portfolios of late, actually, where over the last couple of years they've stuck with a strategy that is a very outdated one,
Mm-hmm.
and because of that, their clients are down like 20% over
Yeah.
2 years,
Yeah.
and that's not uncommon. I've seen that on multiple occasions because they've followed this strategy for so long, and or they've been in a what I call the target date maturity mutual funds. Those are some other people that have had very subpar returns in many cases because it follows this old outdated strategy. If you're seeing then you likely have an advisor that is not paying attention, or sometimes they're with a firm that disallows them to actually do things. And that's one of the reasons I left big Wall Street, is because a lot of firms will, in order to shield themselves from a lawsuit or whatever, they'll opt to just do nothing.
Mm-hmm.
And that's an easier defense than doing something. And that, in my opinion, is the wrong way to go about it as well. There's even a lot of firms that will penalize their financial advisor if there's no activity in an account.
Wow.
Well, sometimes, this is very prevalent. This is almost every large firm out there. There's some sort of penalty for not having activity in an account. There's a lot of times when there should be no activity in an account, right?
Correct. Correct. It would seem
So,
like sometimes that's the best thing to do. If you're doing really well, why would you want to make a move just because your firm says you have to have activity in that account? Maybe the activity
right.
in the account could just be an email to your client saying we're not making any activity
We're
right
not
now.
we're not doing anything this month. Yeah, exactly. We're not doing any, actually, month, the quarter, right? Yeah.
Well, you brought up a valid point, and you were talking about. Let me see if I can bring back where you were. You were talking about old, outdated strategy. And when an old, outdated strategy is something that you are stuck with, oftentimes, again, I'm going to come back to this uneducated consumer. Sometimes you don't even know that you're in an
And why
outdated
would you?
strategy
You're the
outright. Or
consumer.
so what's a move to make? Is it hey, I just want to check the barometer of the market out there, calling you, and how do you handle that? Somebody calls you, they're brand new. What do? You do an analysis of their account. How do you determine if they have an outdated strategy in their portfolio or their plans?
Well, most of them it's pretty easy to see because there's one particular strategy out there. I'll just call it out and I'll get the hate mail. But it's the 60/40 uh, methodology of managing your risk, which is 60% equities, 40%
Got it.
stocks. Or 60% equities, 40% fixed income, or vice versa, depending on how you want your risk to go. And that hasn't worked for over a decade on a consistent basis. But people still follow it because it's an easy story and it's also easy to manage. You don't really do anything, right? But you charge people for it. So I've never understood that. Now, there's an argument that maybe this strategy is coming back now because rates are rising
Mm-hmm.
on fixed income. And
It's
I
kind of like
would,
it's kind of like paisley and other things. It's always coming back in fashion. Bell bottom jeans came back, John. Why wouldn't the 60/40 strategy come
There you
back in
go.
fashion?
And it may. It may. And that's where it's important that I pay attention.
Yeah.
And if the mathematics of that begin to work again, that I make adjustments in what I'm doing. But right now, even with rates rising, I don't believe, based on the mathematics of it all and what's going on, that is likely to work going forward anytime soon. It could change. Things could change tomorrow. That would change my view. And I think that's the value of, and again, some of the people to run away from are those that say this is never coming back, right? The strategy is never going to come back again. Run away from those people. I take the approach that, hey, if the data changes, if the environment changes,
Yeah.
then we need to adjust. But right now, that's just not the case. And it hasn't been for a very long time. And you still have people following it because it's a very easy story to tell. And it's a very easy story and strategy to implement. Sometimes, so I say, always simplify things as much as possible, but don't oversimplify, because both overcomplicating and oversimplifying can really put you in a bad position.
So talk about for a second, and then share your contact info. I'm really curious what that initial call looks like if somebody just even wants to do an exam or analysis of their account. I wouldn't know looking at my account if I have an outdated strategy or a current dated strategy. So I'm sure there are many people in our listening audience that are the same way. So what's that initial call look like, and then how do people actually reach out to you?
So an initial call with me, it really looks like, hey, I just want to get to know you. What do you like to do? And it has nothing to do with your portfolio. That's the first thing, because that will tell me that will begin to tell me what kind of risk parameters that you may want. It doesn't get me all the way there, but it begins to tell me the story by getting to know you.
Mm-hmm.
And that's more important than the math in my experience. From there, to look at a statement, right? I'm going to look at how you're invested now. I'll look at your returns. I'll look at the fees and charges, those that are readily up front. I'll see if you're potentially paying too much, which is not usually the case anymore. It used to be, but usually not anymore. I'll look for are all the funds or things that you're invested in, do they all say the same firm name? And we talked about that before. That's a red flag. This is the stuff I do in the first 5-10 seconds. And then I'll look and see how it's broken down between fixed income and equity. And I'll see if there's any alternative assets in there, whether they're through a fund, an exchange traded fund, something like that, or if it's direct investments in something. If there's none of that, then we need to dig a little deeper, because in this day and age and at this stage that we're in the market, again, not investment advice, I'm going to say, generally speaking, there should be some things like structured products, that type of thing. Then we're going to ask, how are you protected? Mm-hmm. Do you have annuities? Do you have life insurance? Do you have long-term care insurance? If your advisor hasn't suggested any of those things or even talked about those things, then you might have a problem and we should talk further. Maybe I'll look at it and say, you know what, everything's fine. Why would you want to leave? And maybe the answer is, I never hear from them.
Right.
I never hear from them. They never call. They never write.
Hey, it sounds like my Jewish mom.
Right.
He doesn't call me. He doesn't write. He doesn't visit any longer.
That's right. And then what I often hear too is I'll hear like, well, my advisor did this, and I don't know why they did that.
Right.
They moved this money over here, and there might be a very good reason, by the way. Often is, usually is. But if you don't understand what's happening with your money, that's a problem. So there's oftentimes when I will volunteer to help them figure out even where their money is and why it's in different accounts, because most people need different accounts, right? Your IRA account, your taxable account. There's reasons for a trust account. Maybe there's reasons to have different accounts for different things, but you need to understand why and where, and why some investment portfolios are different in this portfolio that's in this account versus another account, you need to at least have a modicum of understanding as to why those things are different and what they're doing for you. So that's kind of a first or second phone call. Sometimes that goes into the second because most people are not going to bring their
Right.
statements to me because they've never met me on the first phone call. But if what we talk about is interesting to you, you send me your statements, I look them over, I come back to you. We've already set up another meeting. We set up, if we're interested in moving forward on both sides, we'll set up a meeting then for maybe the next week to get together. And by then I've gone through your current portfolio. I'll have some suggestions for you based on what I've heard. And we discuss it back and forth because I might be wrong. I've only talked to you for 15, 20 minutes,
Right.
the first meeting.
Right.
So what do you think? And it's a collaborative conversation. It's not me telling you how you should do something. It's collaborative.
So to get the ball rolling, here is how you get in touch with John. I'll give you the first part of it, and he'll fill in the second part. But I know the first part is text the word life to 321-421-5213. That's the word life, Life. Text it to 321-421-5213. And here's John to tell you how to get in touch with him other ways. That was pretty good. I just gave you the handoff. You and I should start a podcast or radio show.
That's right. So you can also reach out to me at Guardian Rock Wealth with a TH on the end of it, guardianrockwealth.com. There's a plethora of information out there that you can use. There's all the podcasts, there's some written blogs, there's all sorts of things like that. And there's a contact us page. Super easy. Click that. Tell me how to get in contact with you or ask me a question, whatever you'd like to do. I will get back with you. That is a promise. I will get back to you within 48 hours at most, probably closer to 24 or less.
I've even had instances where John gets back to me like in 10 minutes.
That's right.
You can't promise that if you're a podcast listener, but he's probably faster than he actually is saying. I just don't want to give away the shop here, but he's very good. He's very responsive. John, thanks for sharing your wisdom and your expertise on the podcast today. For those who are in our listening audience, don't forget, we're not just building your portfolio. We are building your best life. Let's build the life together right here on the podcast. Thanks for being here. Thanks, John, for being.
All right. We'll talk to you soon.